Hi, I'm Puneet Arora and I lead our international tax financial services practice. I'm here to talk to you about the application of certain US tax reform provisions in the context of asset management. If you look at accumulated foreign earnings and the tax reform, it requires a mandatory toll charge and a mandatory repatriation of those foreign earnings under the Trump proposal as well as under HR1 blueprint. The tax rate under the Trump proposal is 10%, and under the HR1 blueprint, it is 8.75% for cash and cash equivalents and 3.5% for all other assets. If you look at the definition of HR1, it is very broad that it covers every US shareholder of a CFC or a 1050 company. Now let's take this and apply it in the context of asset management. Clearly, we've all been talking about the impact for US corporations with foreign subsidiaries, but in the case of asset management, we often find partnerships at the top end. And so if there is a US partnership that owns 10% of a foreign corporation, which is a CFC or a 1050 company, we're in a situation where the partners in the US partnership may be subject to this mandatory toll charge. Take another example. You have a foreign partnership. You often see Cayman partnerships. If you have a US person behind the Cayman partnership that economically owns 10% indirectly in that foreign corporation, they could also be subject to this mandatory toll charge. Take a third example. You have a foreign corporation that is a CFC under the constructive attribution rules. Here, unless you have a US person who indirectly owns 10% economic interest in the foreign corporation, simply because the foreign corporation is a CFC under the constructive attribution rules, the impact may not be felt under these provisions. So here are some of the examples to illustrate how this specific provision under the US tax reform proposal could impact asset managers. And we have an alert out which highlights some of these examples and a few more for you to look at and make an assessment.